tomorrow's non-farm payroll report may move the markets in a big way. Last month, that report was much stronger than expected, and it really hammered interest rates. What will happen tomorrow? Well, stay tuned. We're going to talk about it. We are seeing interest rates sitting at almost 30-day highs today. The Mortgage News Daily Tracking Poll has a 30-year average fixed-rate loan at 7.20%. Last week, we were at 7.12% in that same poll, so we're up about 1/8 of a point over last week. We were at 7.03% in that survey 30 days ago. You look at Freddie Mac. Freddie Mac's survey has us at 6.9% nationally. The MBA has us at 6.93% nationally. So those two polls, of course, include the fact that borrowers may be paying points to buy that rate down. The Mortgage News Daily numbers that we listed, that 7.20, assumes borrowers are paying no points. So we call those par quotes. So that gives you an idea of what the markets are doing and what they've done over the last 30 days. I will tell you that the markets are very jittery right now for a number of reasons. Number one, we saw Fitch downgrade the U.S. Treasury from AAA rating down to AA+. There are reasons for downgrading. We're issuing too much debt. The Treasury is expected to issue $1 trillion in bonds in the Q3 of this year. That is $300 billion more than the market had anticipated. And of course, that's because we are spending way more money than we are taking into the Treasury, and we're having to issue a tremendous amount of debt. Keep in mind that when you flood the market with a supply of bonds, increased supply of anything drives the price of that commodity down, and the yield on bonds moves inverse to the price. Think of it this way. If you're trying to induce somebody to buy a bond when they're not interested, with the current yield being paid and with the current price being charged, you're going to lower that price in order to entice an investor, and you're going to have to offer them a higher yield in order to purchase it. Well, the market's doing that on a very broad scale. It sees $1 trillion in supply coming, and companies like Fitch that rate our debt rating see all of that additional supply, and they go, well, it's going to be worth less money. And they're simply making adjustments based on that reality. I'm seeing a lot of folks that are questioning and seeing politics at play in this Fitch downgrade. I really don't, y'all. I think that they are just acknowledging the fact that we're issuing more debt than the market can comfortably bear, and that's going to weigh higher in interest rates as a result. Additionally, you saw ADP come out with employment news that was much stronger than expected yesterday. That gives us a little bit of a dark cloud over tomorrow's non-farm payroll report. And here's where it's kind of a dichotomy. It's good news if jobs are up and if the job market is strong, but it also signals to the Fed that they may not be done with interest rate hikes. Remember that there were a number of signs earlier in the year that were pointing towards recession. Every time we get a report that steers us away from that, it sends a signal to the Fed that they've got some more work to do with regard to inflation. So that jobs number tomorrow, it could come in strong. The one from last month was a blockbuster, much stronger than expected, pushed rates significantly higher. We're knocking on the door of that again today. We are back pretty much to the same levels that the non-farm payroll report last month took us to. So the question is, what do we do ahead of tomorrow's report? Bluntly, I would not be floating going into tomorrow's report. If it surprises again to the upside, which it may based on ADP's numbers yesterday, then we may see rates higher still after that report tomorrow. So I would not be floating going into that report, particularly when we're getting additional news of an inflationary nature. Gas is up 30 cents in the last week. Oil is up $10 a gallon in the last 30 days. Y'all, that will start filtering through into other prices. And as it does, we're going to see a slowing in the decreases that we've seen in inflation at the headline number, if not headed in the other direction, especially when you look at the additional debt issuance that we're suffering through as a country. So in any event, buckle up for a rocky ride, because we may see rates higher before they head the other direction. A lot of it's going to hinge on tomorrow's ADP. A lot of it is going to hinge on July CPI when that number comes out next month. In any event, stay buckled up, stay tuned to this channel, and we will bring you all of the news as it happens. You have all of my contact information on the screen. We're always blessed and honored to have your referrals. We do mortgages here, so if you need help financing a property for one of your clients, give me a shout, and I will walk them through it and make sure they have a terrific experience. In any event, stay blessed, stay safe. We will talk to you next week.